We'll go to our first polling question. You can't open a newspaper these days without seeing some headlines about the demise of the consumer, about rising consumer debts, delinquencies, and losses. And this leads us to the first polling question. Which of these statements best describes your view on consumer credit performance over the next 12 years? A, consumers are overextended and credit performance will get much worse. B, this is a normalization of performance and credit will stay the same or modestly deteriorate. C, credit tightening has already started to occur and vintage loss performance will improve. Or D, a combination of both B and C. So as the poll numbers come in, I'd like to ask each of the panelists to get their thoughts on the overall consumer credit, where they feel we are in the credit cycle, and how some macro factors can influence credit performance. So actually the poll question is up, so still waiting to see, but it looks like 50% of the people think credit tightening has already started to occur and vintage loss performance will improve, or it's a combination of both B and C. So I'll turn to the panelists now to go through some of what they're seeing in the space. So maybe Jing, do you want to take a first shot at it?
Next slide, right?
Yeah.
Sure. Do you want to move on to the next slide, right?
Yeah, can you go to the slides, please?
He didn't give you a clicker?
Yeah, I do, but going back and forth between the presentation and the poll is out of my control. So, there's the first slide.
Sure. Hi. Good afternoon, everyone. So, and if you look at the broader pictures, according to the New York Fed Credit Survey, the consumer debt just eclipsed its previous peak by about 1.3%. So it's currently standing about $12.84 trillion. So it's a sign of consumer releveraging. But if you break down those numbers, as you've seen in the bottom left chart, like most of releveraging comes in the form of auto loan debt and student loan debt. So if you compare these two components to their previous peak in, let's say, 3Q 2008, this debt has grown by about 44% for auto loans and about 120% for student loan debt. And the biggest component of the consumer debt, the mortgage debt, is actually still shy of the crisis peak. And credit availability does play a big role in that. And not surprising, if you look at the bottom right chart, auto loan debt and student loan debt are the ones that have seen the highest pickup in delinquencies. So again, we're talking about absolute numbers here. So since the crisis, we have about 6.8 million additional households being added. And if you divide the entire household numbers, you divide the entire household debt by the total number of households, the average debt per household is actually down from the crisis peak. And if you look at other metrics like household DTI, it's actually pretty close to the multi-decade lows. So we would say that in consumer health is pretty stable at this point. But again, we do want to caution that there's some kind of pocket of weaknesses, and the overall credit metrics do not really capture the full pictures. Like you've seen some expenses like rapidly increasing rental cost, healthcare cost, they're not captured in these equations. Like for example, like since the crisis, the rental cost has been increasing by more than 30%. And this has much more disproportionately negative impact on borrowers down the credit spectrum. And again, so some numbers context. For renters, if we break it down by different quintiles, the lowest quintiles will spend more than about 48% on housing costs and 18% on healthcare costs. So overall, we say that consumer health is in very stable conditions, but you just have to pay attention to some early warning signs for that, right?
Great, okay. Thanks, Jean. And Mary, do you have anything
Sure.
to add?
Can everybody hear me? Okay. First of all, thanks for coming out. I'm astounded anyone showed because it's so early. If there's any press in the audience, any of my comments are off the record. And finally, there's a number of disclosures that I can provide. So if you want to see any of those, rather than bore you with reading it, we don't have enough time for that. Give me your card, I'll send you our disclosures. So, with regard to the U.S. consumer, is the U.S. consumer over-levered? Interesting, no one in the audience that participated in the poll felt that they are. I would agree. I'm somewhere between B and C, and that's or C and D. That's where everyone That's where everyone's split. And there's lots of data that would show that the U.S. consumer is not over-levered. I'm going to go through a little bit of that. The other part of the question was, where are we in the consumer credit cycle? I would say we're late stage. From here, we would expect some modest deterioration, but to this point, we feel that the growth in consumer credit has really represented a normalization of credit. Now, some of the data that would show that the consumer is not over-levered, I would go to, first of all, the household debt service ratios. Now, by that would include all payments, whether it's a mortgage payment or if you're a renter, it would assume a certain payment of your income. And if you have an auto loan, or it also would include an auto lease. So this is the number is a percent of net disposable income. The current debt service ratio has dropped by nearly 2.5% since the peak point, which was in Q2 '06. It's currently 15.47%. At the peak, it was 17.82%. And guess when the prior peak before that was? And it was almost the same number, was in Q2 1986. Now, the current level of debt service is actually very consistent with the level that we saw from 2000 through like '04. So in that respect, I don't think consumers are over-levered. The second point is the composition of debt. So there's been a large reduction of mortgage indebtedness as a percent of total. At the peak of the financial crisis, it was about 3/4 of total consumer debt. Now it's about 2/3 of total consumer debt. Part of that, we do have a reduction in home ownership rate, but I think it's a healthier proportion just in terms of total. The economy is strong. Our economists actually feel they're a little bit more optimistic, I'd say, than consensus. They're projecting 2.1% GDP for the remainder of 2017 and modestly above potential 2.6 in 2018. So we see a strong economy persisting. And as far as Fed policy, we think the Fed is going to continue to take very measured steps. So I don't see a lot to really derail U.S. consumers. And then finally, I'd point to the savings rate that is currently in the 3 to 4% range, which is off the peak. We actually had gotten as high as 11% in the wake of the crisis. But I think this is a sustainable run rate, and overall, I think the consumer is in pretty good shape.
Great, thanks. So it sounds like you're in agreement with Jean on that. Anne,
Yeah.
do you have anything to add, please?
I would agree with that as well. My answer would be a combination of B and C, so that would, I think the D answered there. I do see a slight deterioration in performance, but I think it's really back to normalized levels. From an economic data perspective, I don't think that the economy is overheating or really shifting into a recession. If you take a look at the graphs up on the screen right there, you see that GDP is really coming in a little below average levels. So that shows that that's still strong GDP levels, but not really something that's overheating. And then we do see that inflation is still at pretty low levels as well. I think one thing to note that's pretty interesting that's detailed on the graph on the right there is the Fed cycle and Fed increases. What we've seen in the past 2 recessions is that typically, the end of a cycle comes about 9 to 18 months after the Fed stops increasing rates. When, during the economy now and what the Fed is doing now is that they're actually slowly increasing rates. And so that's very different. So, that leads me to believe that we're really not at the end of a cycle. But with this slow increase in the Fed rates itself, that should really keep credit conditions favorable for our economy and general lending.
Great, thank you. So we are seeing an increase in consumer debt. The next thing we want to focus on is, are we also seeing an increase in ABS issuance, or are finance companies and banks looking for other sources to fund this debt? So Mary, do you want to point us to some data on that?
Sure. So we look at credit card, auto, student loan, and so-called other, that encompasses a number of different non-mortgage sectors. Today there's about $720 billion outstanding of these various asset-backed securities. At the peak we had slightly over $900 billion outstanding. Now in terms of where has the reduction come from, the biggest drop is actually in the credit card space. As many of you know, at one time, banks were much more active in securitizing their credit card portfolios, but because of some changes in accounting and capital rules, banks really pulled back. That said, banks are issuing a good amount of credit cards these days, but really just replacing what's coming up for maturity. As a percentage of all the credit card debt in the U.S. economy, at the peak, credit cards financed about 40% of total. Today, it's only 17%. Similarly, auto ABS amounts to about $100 billion a year for the past few years of new issue supply. And the market had financed about 30% of the outstanding auto loans at one time. Today, similarly, the biggest auto lenders in the country are banks that don't securitize, and the securitization market is financing about the same number, about 17% of the outstanding auto loan origination.
Great, thanks. And Ann, I know you have some slides that you wanted to highlight.
Sure, if you go to slide number 10, I believe. I concur with Mary's thoughts there. You know, we are seeing that total debt is around $12.8 trillion, which is slightly higher than the period in 2008, and that was detailed on a slide previously in the presentation there. But we are seeing that overall percentage of ABS debt on an outstanding basis and a new issuance basis has really been declining. And it's really been hovering around, like, you know, the $200 billion mark. You know, I expect that to continue. I don't really see like a dramatic increase in ABS new issuance debt going forward either.
I would just add, just a comment about student loans. Probably everyone knows that the government ended the FELP program in 2010. We've had a little bit of ABS supply since then, which is mainly of seasoned loans. Basically, about 95% of all the student lending in this country now is done directly by the government, and it's on balance sheet.
Right. So that brings us to polling question number 2. Again, if you want to log in, you can do imn.org/polls. The question here is, what's your view on the U.S. ABS volume for the rest of the year? Will ABS issuance A, increase at a faster pace than year to date, B, stay at the current pace for the remainder of the year, or C, slow from the current pace? So while everyone's submitting their answers, I'll just go down the line, and if each of the panelists can give us their view on ABS volume for 2017.
So our projection is $187 billion for the full year, $37 billion for the remainder of the year. That's about flat to 2016. And I would just simply point out that although it seems like the ABS market is in a constant state of energy, a lot of it is simply portfolio managers trying to replace what's running off. If you look at net supply, it's basically zero.
Jing,
sure.
Go ahead.
So yeah, like year to date, we've seen very robust issuance volumes, and we believe that it will continue for the rest of the year. Our internal view is that the rates will continue to stay low from the midterm, and that will continue to drive like the investors' instinct for hunt for yield. And again, like all the consumer ABS does provide a sweet spot in in providing kind of like a comparable use to other credit products while providing like a short duration exposure. So we do believe that it will continue to be supported by the demand, and our full year projections are going to be 191 billion, and most year-over-year growth from asset products, right?
Okay. Ann?
My projections are not as precise as Mary and Jean's, so I'm predicting about 190 to 200 billion, which is consistent with what we've seen in the last couple of years, except for 2014, which is a little bit higher. I think that the issuance so far, year to date, is quite a bit higher than it was last year. But I think that's really because a lot of issuers front-loaded their transactions. I was definitely encouraging issuers to front-load their transactions just because of concerns about geopolitical news and news from our own government that would cause volatility later in the year. So, I think we'll continue to see more issuance, for the rest of the year, but I think the pace is going to slow down a little bit.
Okay, thanks. So looking at the polling results, it looks like majority of the audience thinks that it's going to increase at a faster pace or stay at the current pace. Only 30% think it's going to slow from current levels. So what we've seen so far is that consumers are taking on more debt. There's more supply coming into the ABS market. There's some headwinds about consumers' debt burden and how that's going to impact credit performance. So what we're going to do right now is flip to how this is impacting ABS spreads. So we'll just go down the line, ask our panelists, what are they seeing in credit spreads? Are investors concerned? And then are there certain asset classes where spreads may be widening or tightening compared to others? So Gene, do you want to take a first shot?
Sure. So again, like we do see a lot of credit fundamentals deteriorations across multiple corners of consumer ABS space. But again, we do see spreads grinding tighter and tighter over time since the mid of 2016, resulting in constructive year-to-date returns. Just to put some numbers in context, subprime BB used to be around 600 back in last year, and now it's trending close to 350, and triple B is 400 to 200 right now, and resulting in very constructive year-to-date returns. We have about 1 to 6% for down to capital structures, and same for marketplace lending as well. So there are two possible explanations for this disjoint. The first one, what I mentioned previously, is that the yield compressions continue to drive investor demand for this kind of short duration exposure, which consumer ABS is providing that. And the second one is that even though you're seeing fundamental deteriorations, investors still believe in the structures that have in these structures. Like in subprime autos, even though it keeps hitting the headline rates for that. But again, these structures seeing the credit protection for these structures in the form of excess spread, junior subordinations, reserve account, are in there to protect the junior bondholders from principal losses. And even in the crisis, we do not see any of junior tranches take any principal loss. And we've seen much more recent credit upgrades than credit downgrades in this space as well. So I think in conjunction with these two factors, I think this is why we've seen spreads keep getting tighter and tighter over time.
Great. And Mary, are you seeing the same thing?
Well, yes. The technicals are a very powerful factor here. This graph shows that outstanding securitized sectors, ABS has been basically flat, but mortgages in the CMBS sector, basically, this is what I was talking about earlier when I say, investors need to they keep running just to stay in place. So net supply is running off. This is a very powerful factor driving spreads. The other issue is, of course, we all know that the market prices to swaps, and investors look at not just spread, but they look at absolute yield. The fact that swap spreads have more normalized in the last year helps to drive the spreads tighter because on an all-in yield basis, the market's benefited from that. Finally, I think when you're thinking about putting on credit risk and you're thinking about how long will these positive factors, how long will the stars remain aligned, if you're looking to take credit risk, there's nothing like buying something that's short and rolls down the curve, and ABS is one of those sectors that's kind of a natural fit for a lot of money managers.
Great. And you spoke about duration. I know, Gene, you put together a slide which segues nicely into this, so maybe you could just talk about how duration asset classes and spreads are behaving.
Sure. So just following with what Mary said, that so this chart shows like a breakdown of like yield for across different credit products, broken down by weighted average life and ratings. So we can taking from single A to double B. So we've seen that the blue dots and the black dots representing the marketplace lending and subprime autos, they're offering kind of a comparable yield to other credit products like U.S. corporates, which is represented by yellow dots here. It's like they're all both at a range of 3 to 5%, but they're at a much shorter durations. Like for example, for MPL, it's probably close to less than 2 years, and subprime auto is probably close to 1.5 to 4.5 years. So it's still very attractive compared to other products.
Great, thank you. So what we started with is the overall consumer credit. We talked about ABS issuance and spreads. Now we're just going to dive into some of the asset classes specifically. The first asset class we'll focus on is auto loans. So as Mary mentioned on one of her slides, we did see, and Gene mentioned as well, is that auto issuance, ABS issuance, was increasing. If you read the press, subprime auto in particular has been the subject to a lot of negative press. Some reporters trying to run parallels between the subprime auto space and the subprime mortgage space. So what we're going to dive into here is looking at some of the underlying fundamentals and then what we're seeing in credit performance. So Mary, do you want to start and see what you're seeing?
Sure. So everybody loves to hate subprime auto. And ever since the financial crisis and The Big Short, the book, it seems like there's so many constituents out there that are afraid of missing the next big short, but I just don't see it in the subprime auto lending sector. So let's talk about some of the issues there. I mean, first of all, the car ownership rate in the United States is nearly 90%. Nearly 85% of people drive to work, and only 10% of those households carpool. That means that there's a lot of cars on the road that constantly need to be replaced. The average age of a vehicle on the road in the United States is actually 11 years old. And so this replacement cycle and, this idea that easy auto lending terms are driving auto sales is just not the case. Now, in terms of where have we been lending, the subprime component, which is auto loans 660 or less, is currently in line with the proportion of subprime consumers in the population. It's currently about a third. In the run-up prior to the crisis, it was as high as 47%. So I would maintain that the proportion of subprime auto lending that's going on, and you can see that's the red line here, the outstanding is over $1 trillion of auto loans. The amount of securitization is the green bars. It's only 17%. The securitization market is definitely not driving easy financing terms. Now that said, there are a number of smaller subprime auto companies that started up after the financial crisis, and they are reliant on the securitization market, and I think that's a thing to keep an eye on, but I see it as more of an alpha sort of risk rather than a systemic risk.
Good. And what we've heard from the panel so far and in the audience polling is that credit performance really is a normalization and not a pending economic downfall. Gene, do you want to go through some of the collateral statistics and performance we've seen?
Sure, Eric. So this chart shows the different metrics like delinquencies, CDRs, and severities across both auto ABS in the prime and subprime market. So within auto ABS, where we've seen delinquencies and default rates are picking up year over year, and especially down the credit spectrum in subprime autos, you can see that if you calculate it based on the recent peak, and we are on track of surpassing what we have seen during the crisis. And loss severities are also picking up as well, as we expect used car values to trend downwards in the near term. So why are we seeing all this kind of performance deteriorations? So go to the next slide, right? So there are two reasons why we think that, the main reasons would be what we're seeing, like loosening credit standards, and it comes in two forms. So first one we think about is losing credit standards across the same issuer. So if you look at the bottom left chart, this shows a issuer level, kind of like what's the weighted average origination terms across different vintages. You can see that this is very consistent across all different issuers, that they used to be issuing loans about 4 years to 5 years, now is issuing more to 6 to 7 years. So if you extend the loans more and more longer, you're exposing the investors more to the economic downturn risk as well. And most of the time they're doing an effort to drive down the minimum payment, which in fact they would drive up the default rates. So a next part of reasons we say is that shift in mix towards deep subprime. So what it seems like, if we break down the subprime lending and like since 2010, what we characterize as deep subprime are those loans with below 550. The share has grown from like 5% back in 2010 to like 20%, and more, like 30% here. So I mean, it still considers a very small share of the subprime lending. It's still significant. But again, if you break down the previous slides, delinquency CDR charts by their weighted average origination score FICO buckets, the difference in performance is really stark. So a combination of both loosening credit standards from same issuers as well as shift in mix towards deep subprime are driving what we have seen in deteriorations.
Great, thanks. So we focused on the borrower, we focused on lending standards for finance companies. Obviously, the other component in the equation is recovery values and severity. So, Anne, do you mind going through what you're seeing on recovery values?
Sure. I mean, one of the big topics that we've been all focused on is used car values. And so I thought it would be interesting to drill down on the two indexes that people are taking a look at. You know, historically, everyone focused on the Manheim index, but more recently, people have started looking at the J.D. Power or NADA index as well. So let's just take a look at exactly what their methodologies are. For Manheim, what I think is important to note is that they don't factor for new vehicle pricing, which basically leads to higher values due to inflation and additional content that's added into the vehicles themselves. The other thing that they do is they analyze prices on used vehicles of any age, and they look at all Manheim U.S. sales that fall into one of the 20 market classes. In this case, that excludes anything that's related to heavy trucks or motorcycles. In addition, they make adjustments to eliminate transactions that have price or mileage outliers when they calculate their average mile and price for each model and make. And they also make some seasonal adjustments. So that's kind of in a nutshell what the Manheim index is. And then for the J.D. Power index, you know, it differs a little bit where they only look at vehicles that are 8 years or younger. The pool itself is restricted to a fixed pool. And then they source data from AuctionNet, which includes 80% of the nation's auctions from Manheim, ADESA, SourceNet, ABS, and other key independent auctions. And lastly, they forecast what they think is the used car values for the current year and the next 2 years. So when you just look on, you know, a face level what the two methodologies are, it seems like the J.D. Power methodology maybe is a little bit more comprehensive, or it's something that you should focus on. But I think in terms of the actual data itself, you know, there are some questions about, you know, if they're looking at, you know, these specific things, why the data is coming out the way it is. So one thing, you know, to note is that I think for the J.D. Power itself, the peak value of used cars occurs in May of 2014, whereas I think it makes a little bit more sense for that to occur in 2011 when we see, you know, strong used vehicle sales and low supply, and that low supply was really magnified by the Japanese earthquake. So I think that's one data point that, you know, we need to focus on in order to make sense of the data. And then also, I think what's interesting and maybe coincidental is, you know, the increase of the used car values for each of these indexes since the beginning, since 2009, and it's basically roughly the same. So kind of hard to understand that as well. I think it's important to maybe look at both indexes, but, you know, I give a little bit more preference to Manheim.
Good, thank you.
I just wanted to go back for a sec to Jean's comment that there's been a shift in the market to deep subprime. Borrowers with a FICO of 550 or less we are seeing more issuers in the market that have strategies that finance deep subprime borrowers. You know, to some extent, I think the ABS market has well served startup companies since the financial crisis, and finance companies, especially in the subprime auto lending sector. We have probably nearly 20 different shelves financing in the market. And as a proportion of total, these so-called deep subprime guys have increased as a percentage of total. That said, you know, the market is very fragmented, and the credit enhancement and structure is always tailored for the expected losses. Now, when I look at these sorts of borrowers, these are borrowers that in the past used to have to go to buy here, pay here type lenders. So the fact that the securitization market would provide financing for these sorts of consumers is actually a great thing, because when these borrowers would go to buy here, pay here lenders, they could not walk into a franchise dealer and get fair terms on a vehicle. You know, they'd be going into these independent lots, they'd be paying 2 times the value of the car, they'd be paying very high interest rates. So I think the market is well serving these sorts of consumers if you're properly credit enhanced and if you're doing all the credit checks and so on. So I think it's just a number. The fact that deep subprime has increased as a proportion of total, it doesn't mean the market is deteriorating or not deteriorating. It's a very fragmented market, and I think that needs to be taken into perspective.
Great, thanks. So turning from autos, we'll now look at another segment of consumer lending. This is an emerging asset class and maturing asset class as well that's increasing its reliance on ABS securitization. So we wanted to take a look at what we're seeing in ABS volume as well as credit performance. So Gene, can you highlight some factors that you're seeing?
Sure. So just to give some high-level numbers, so as of Q2 2017, we have seen a very robust kind of securitization issuance volumes. To date, in our database, we track about 97 deals being securitized so far, and totaling about $22 billion. And among the recent issuances like 2017, relative to more the seasoned deals, we're seeing the deals are being concentrated more to rated deals so far. And the size is growing. It used to be like 100 million in size. Now it's trending towards $200, $300 million per deal. And now it's become more programmatic in the form of the structures are more similar from the same shelf. And it also concentrated within the bigger players like Avant, Prosper, Opportune, Lending Club, and SoFi. So in terms of performance, next slide, right? It is very platform dependent, and it varies across kind of borrowers with different credit profiles. Like for example, like a Prosper and Lending Club lending to more kind of 700 and above, and Avant is more about 650 and below. And to date, we have about 14 deals across 5 different platforms to breach the performance triggers. And if you look at the charts at the bottom two, like say that the performance is not great, like look at those below 660, you see that their cumulative loss is probably approaching more to like 25%. But again, we especially when we believe that these unsecured loans are not placed very high in terms of the consumer payment hierarchy. But again, this is the argument is very similar to what we have in subprime autos, is that the structures are pretty resilient. You've seen that a lot of this have huge excess spread, and in terms of junior subordinations, like Avant, they have like 20 to 25% for that to protect the principal losses against principal losses. So again, we are more bearish on the fundamentals, but we are bullish on the structures itself.
As Gene mentioned, we are seeing an increase in ABS issuance as well as a reliance on rated transactions and a trend toward increase in ratings. All deals in 2017 did have a rating compared to none in 2014. KBRA has been active in this space. We've rated 25 of 29 consumer deals since 2015, and we were the sole rating agency on 14 asset-backed securitizations. So We also published a piece on Friday about a Q3 update on marketplace lending. That's available on our website for download for free. But given that backdrop, we just wanted to highlight what we're seeing in terms of rating performance trends. As Gene mentioned, performance on some issuers has been increasing, but the structures have worked as expected, and that's really the foundation for the positive rating trend that we've seen here. So 12 months after closing, 70% of all A-rated bonds have been upgraded at least 3 notches to AA, and then 10% have been upgraded 4 notches to AA+, while 20% had their ratings affirmed. So I think it's a positive factor that even with some credit deterioration, the structures are working as expected and give us coverage multiple levels that allow to support the rating and then also offer upgrades. Mary, I know there's a parallel between marketplace lending and consumer lending, so do you want to focus on maybe something we're seeing between the borrowers in both those asset classes?
Sure. So I think there's some pros and cons when you look at the so-called marketplace sector. The positive factors would be that the average balance is roughly 700 FICO, no matter which platform you look at. So this is a solidly non-prime consumer. The other factor is that the consumers have above the median average income in the United States. Most of the different platforms, the consumer's income ranges from $70,000 to $90,000. But on the negative side, and I guess one other thing is the loans are basically 3 to 5 years, so they're relatively short loans and they amortize. Many of them are debt consolidation loans. Now, the flip side of that is that the typical loan balance for a marketplace platform ranges from about $12,000 to $16,000. Some of them are larger. There's lots of data that I can point to that would say that this is a lot of unsecured debt for consumers. If I look at Fed surveys showing average credit card debt by income percentile, this $70,000 to $90,000 range, those consumers typically have $5,000 or less in credit card debt. If I look at a master trust pool, the average balance outstanding for consumers that actually carry a balance is less than $2,000. This shows you the distribution of credit cards. This is a Fed survey by credit score. This shows you that the majority of borrowers, and I'm forgetting the percentage, but it's something like 2/3 of borrowers have a $5,000 or less balance. This is for consumers that carry a balance. So therefore, when I look at the kind of balances on these marketplace loans, they're high relative to typical consumers, which suggests to me that this consumer might be a bit extravagant. And so I'm not so worried about that when we're in the good part of the credit cycle, but I worry when it eventually turns what's going to happen. Gene, of course, you mentioned the debt prioritization issue. Are these consumers going to reload on their credit card debt? I think there's a lot to think about here. The other thing I think that is interesting, and I think in the wake of the hurricanes, it's going to be very interesting to see the regional performance on some of these pools, because basically the idea is that it's a very high percentage of these loans are paid with an automatic charge to the credit card, to the checking account. So there's not really a lot of more hardcore servicing going on these portfolios. And in certain of these areas that have been hard hit by the hurricane, there's going to be unemployment for some period of time. And I think it's just going to be very interesting to track the regional performance there.
Great. Okay. We're getting close to our time limit here. We have 2 more assets that we want to cover, so we'll try to take a quicker run through each of these. So the next asset class we want to talk about is credit cards. And do you mind going through, seeing what you've seen in terms of revolving credit as well as credit limits?
Sure. So this first graph here, it actually discusses what revolving credit outstanding is and the increase of that versus non-revolving credit. And you can see that as of July 2017, total consumer revolving credit is a little over $1 trillion. You can see that yellow line there, that revolving credit dipped a little bit after 2008, and it's since increased to about the same levels, whereas in contrast, non-revolving debt has increased quite dramatically. And then I think the second part of your question addresses, what factors or what stats we take a look at to basically understand, performance of a revolving credit. If you can just flip to the next slide here. The things that we really focus on, of course, are bankruptcies. And you can see there on the top left chart that bankruptcies remain significantly lower than where it was at historical levels versus 2006 and during the credit crisis. So that's actually a very positive sign. Unemployment remains very low. If you look at the correlation between credit card performance in ABS versus unemployment, it's very correlated. And with low unemployment, that bodes well for performance in credit cards. Of course, we look at delinquencies and losses, and even though those levels have really trended up a little bit, we think it's really back to more normalized levels. And lastly, in terms of credit limits, we are starting to see that come up again. But I think it's from a general basis, credit limits and underwriting is still quite conservative to the 2005 to 2007 timeframe.
Great. Nice quick summary. Moving to student loans, obviously, education costs continue to rise and outstanding debt continues to grow. So, want to focus on student loan debt and how we're seeing performance there. So, Mary, do you want to go through some of the presentation?
Sure. I mean, it seems like everyone's always battering student loan debt, and I think it is something that we philosophically need to address nationally, but in terms of exposure to the ABS market, we do know that many more families have student loan debt that did not have it, 10, 15 years ago. This slide shows that the proportion of families with education debt is currently nearly 50%, whereas in 1992 it was only 20%. That said, I think in the wake of the financial crisis and with how expensive that education is getting, we have seen a reduction in the amount of college enrollment. You can see that this is showing federal loans. So the blue line you can see peaked in 2010, and it's dropped in every year since then. And that's in line with enrollment, also peaked in 2010, and it's been dropping. The amount of direct loan origination dropped from 116 billion per year at the peak, and it's now around 95 billion. When I look at default rates, this is another area that the press likes to batter. But when I look at default rates, actually the default rates are greatest on the low balance loans. Default rates are the greatest for borrowers who take out a loan and then they decide they do not want to complete the degree. So they have the debt, but they don't have the skills to get a better job and repay the debt. That's it in a nutshell.
Great. Okay, we have a few minutes left, about 2 minutes, so we'll open it up to the audience, see if you have any questions for the panel. Okay, we have one over here. She's got a microphone right behind you.
I have a quick question. Quick question on the subprime auto and its increased share. What's your guys' view as far as all the alternative underwriting data sources that companies are using these days, as far in place of the traditional Equifax, TransUnion, and all that kind of stuff? There's so many alternative places that they can get data, do you think that this is contributing to the increase in subprime auto proportion of the total? And if so, do you think that these data sources that they're using to underwrite these consumers are sufficient enough, or do you think that there's more work that needs to be done to use these as viable sources?
I'll take a crack at that. So I think you're talking about, there's been stories about less income verification going on. So first of all, in terms of the smaller subprime platforms, I think you're still seeing very significant both income and job verification there, because this is a much higher risk credit. Some of the larger, more automated, technology-driven platforms, they would respond that there would be certain jobs, for example, if you say that you're a teacher in Texas or a nurse in Texas or, whatever state, there's a lot of data that that they can point to, alternative data. They pretty much know how much that person makes, and they can estimate what their income is. And I think the strategy there on some of these larger shelves is they want to have the right of first refusal, because if you wait, then the dealer ends up going, showing it to another platform that may not need all those verifications, and you're only going to get a second or a third look. So I think that's the idea behind the strategy. I think the jury is still out whether less verification is useful, but I have to say we've been looking at loan level data on a couple of shelves, and we have not seen a rise in default rate as a result of that. So performance seems to be in line with expectations.
Yeah. And I could just add to that too, being active in the subprime auto space. They are pulling alternative data, but not using the traditional data. When you're dealing in the steep subprime auto space, you have a lot of borrowers who are unscored by FICO. So what they do is incorporate some of these alternative data into their credit scoring models and try to find variables which can predict performance. Some of the things, for example, that you see is utility payments and pulling that in as an ability to pay outstanding debts. So.
And then I think I would just add that historically the subprime auto originators never really looked at FICO score as the biggest component of their underwriting. They always have looked at it because investors understand it and prefer to see a FICO score, but they all have their own internal scoring models that they use, and then use FICO as another data point. So it's not really anything that I think is really different from what's been done historically.
Well, we're over our time here, so I appreciate everybody coming out and listening to the panel here. I also appreciate the panel's hard work. If you have any questions, we're around after. In addition, as I mentioned earlier, all of the slide and the great data that the panelists put together is available on IMN's website. You can just go to the agenda, go to the 12:30 session, and then you could download it right from the site. So thank you for your time.